Hello guys, in this video I'm going to teach about consolidation trading. Consolidation is simply any time when the market is ranging in a specific price zone. Like this zone that I've marked, this is a consolidation. So whenever we have a consolidation, it's simply an indication that we have price indecision. That means neither buyers nor sellers are strong at that particular point. So most people have just been taught that when you have consolidation, you should avoid trading. But you see, the thing is, as much as you're avoiding trading, you must know what to do next after the consolidation ends. Also, there is this concept where you are taught how to trade a consolidation breakout. And let me just show a clear example. Most people have been taught that when you have a consolidation, you're going to have a breakout either to the upside or to the downside. So the concept is that when you have a consolidation, you're here and you're waiting for price to break out to the upside, or you want price to break out to the downside. But if you've been in the market for a while, you'll realize that the market usually doesn't play out exactly the way you want it. There are a lot of times when you will have a consolidation and you'll be there waiting for it to break out the way you want, then you get a fake out. Let me just show you a clear example of how a fake out could happen in a consolidation. So what happens is that, let me just draw this again. What happens is that you have your consolidation, you have price playing around that particular zone, then you get something like a breakout. It acts as if it's a breakout, but in the long run, you come to realize that it was just barely a fake out. It even acts as if it's forming a retest and another breakout, but after a few candlesticks, price comes in goes the exact opposite direction. So this here is a fake out because you had the consolidation, you got the breakout, as most people have been taught, then you got into your trade after the breakout, but it turned out to be a fake out, so it went the opposite direction, and you definitely made a loss on this trade. So I want to teach you the most effective way on trading consolidations so that you can have a high probability of winning whenever you are trading this pattern. I'll just make it clear that trading the breakout is not a problem. The problem is when you independently rely on that breakout and you think that's what is going to determine the next price direction. So the first focus should be identifying the general price direction from the higher time frames. This is something that you realize in almost all concepts that I teach or any analysis that I do. There must be a supporting factor from the higher time frame because the higher time frames will show you the high probability direction. So in this case, this is 0 USD on the 1 hour time frame. You can clearly see that we had a consolidation. This was on 12th November. So let me mark when this day started at exactly this is where the consolidation started. So let me mark at exactly midnight. Then we want to go and look at the previous day because the idea is simple. After spotting the consolidation, instead of just anticipating a breakout from the upside or the downside, you should have a clear clue of where price is more likely to go. So if the consolidation does not break out from the side you are expecting it to, then according to your analysis, it becomes invalid and you leave it alone. So in this case, we want to get a confirmation from a higher time frame that price is going to a certain direction before we can even anticipate our breakout. Because at the point that the pattern is forming, it's hard to tell whether it will break out from the upside or the downside. And regardless of the side that it breaks out, it's also hard to determine whether the breakout is actually valid or it's just a fake out. So let's go to the 4 hour time frame. Here we can see on the 4 hour time frame because it's definitely a higher time frame, so it's more valid. So this is where we have a consolidation on the 1 hour time frame. But now, assuming this is the real time that you are trading, you want to look at the previous market behavior and identify the structure. Then based on the structure, it's easier for us to anticipate the next likely direction. So I want you to see clearly that if you just identify this structure even without drawing anything, this market is definitely in a downtrend. Over the long period of time, or rather over the long run, you can see that price has been forming lower highs and lower lows. That's very clear if you mark it. Price is forming lower highs and lower lows over time, and that's very clear. So first of all, we've already identified that price is in a downtrend. So that means if the higher time frame is telling us that price is in a downtrend, then the 1 hour time frame which is lower must be subject to the higher time frame. It must submit to the higher time frame. Let me use that term. So we want to go to the lower time frame, which is the 1 hour, and whatever pattern we find on the 1 hour, we want patterns that will only patterns that will only be valid if they indicate that price is moving towards the downside so that they can conform to the higher time frame. So we already have the direction to be downwards from the general market structure. So we can now go back to our 1 hour time frame. Back to our 1 hour time frame. It's now clear that we are anticipating a breakout to the downside because we've already identified that the higher time frames are indicating that price is in a downtrend. So we want price to break out to the downside. So in case price breaks out to the upside, let me just give you that perspective. In case price breaks out to the opposite direction, which is not what we're anticipating, then that pattern becomes invalid according to our analysis. So we want price to break out to the downside, which we got the breakout at this point. So you can either get your trade immediately or you can wait for further confirmation. But in this case, it was definitely a good and strong breakout. So you could get into your short position at that breakout. We'll have your stop loss at about 30 pips on Euro USD. And price dropped all the way about 154 pips, having a risk reward of up to 1 to 5, depending with what you targeted. That's how you apply the consolidation trading using the higher time frame. Just to get another view, you can see this market is also in a downtrend, forming lower highs and lower lows. Here we had a consolidation. Since it's in a downtrend, we already have the anticipation that price will break out to the downside. Price got the breakout. You could have taken your trade immediately and placed your stop loss somewhere above that candlestick to about 30 pips. Price dropped about 70 pips, so a risk reward of 1 to 2 worked. We also got a retest to the consolidation, which is even a better way of trading. Let me just extend this. So after the breakout here, we got a retest, which is even a better way. So after the retest, you could still get your trade here if at all you are waiting for further confirmation. And then this next example is actually a fake out because the direction from the general market trend is a downtrend. So we are anticipating a breakout to the downside, but instead the breakout happens to the upside. So in this case, according to my analysis, that becomes a fake out. Though the trade did well and it actually bought, but most of the time, if you want to have a high probability win rate, you want to avoid such trades because it's only very few trades out of the majority like this that will work. Because as long as a trade disrespects the direction of the market, then it can never be a high probability setup. So the setup isn't a high probability just because it went and gathered 100 pips or something. It's only a high probability based on the structure, and it must fall under the discipline of your analysis. So the final takeaway from this video is that whenever you're trading a consolidation, number one, you must have the anticipation of where price will go. So identify the consolidation and make sure you know where price will go first. So it's not upon you to see a consolidation, then wait for it to break out is when you want to take a trade blindly. No, the consolidation must actually respect your analysis prior. So it's you to first know where the market should go based on the high probability direction from the higher time frame or from other tools of analysis. Then after that, it's when you want to anticipate a breakout from that side. So when the breakout happens, it only acts as a confirmation of something that you had already analyzed. So that's why you trade the breakout. So don't just trade the breakout blindly like most people teach that as long as you have a breakout to the upside, you take the buy. As long as you have a breakout to the downside, you take the sell regardless of other market structure. So basically that's it for this video.